All right, buckle up, because the silver market has just turned into a roller coaster straight out of a Hollywood blockbuster. One day it's a bloodbath, the next day it's a party. If you're looking at the silver chart right now, you're witnessing something like a crime scene in reverse, and the culprit is pure volatility. Just last week, silver was on the ropes. On Monday, December 29th, 2025, the white metal suffered a gut-wrenching plunge, nearly a 10% drop in the blink of an eye. It was the kind of move that makes even hardened bulls break out in a cold sweat. And it didn't happen in a vacuum. The CME group had just hiked margin requirements on silver futures twice in a few days, cranking up collateral demands and forcing many leveraged bulls to liquidate. That regulatory chokehold turned a stumble into a full-blown crash. By midday Monday, silver was almost at $71 intraday, the steepest one-day rout in years. But here's the kicker. That crash was followed almost immediately by an equally wild rebound. The very next trading day, silver surged above $70, clawing back much of its losses. Traders on the floor were stunned. Some are already calling this a classic bear trap, where a fake breakdown is used to suck in sellers and then reverse sharply. Bears who piled into the December sell-off found themselves scrambling to cover, turning the tables with a textbook short squeeze. 1 minute, you're shorting silver at $74, expecting $70, and the next minute, the market has the rug pulled out from under you. And the fireworks didn't stop there. Early January saw an even bigger explosive move. When news broke on January 5th that the U.S. had captured Venezuela's leader, safe haven demand flooded back into all precious metals. Silver jumped about 7.9% in one session, vaulting to roughly $76.66 an ounce. usagold.com. This kind of action is dizzying. For perspective, remember silver's run in 2025. It was already on fire, up roughly 148% for the year. In late December, it actually briefly hit the $83 to $84 range, all-time highs in nominal terms. Yet even after that parabolic move and a months-long rally, silver is still eyeing an astonishing 35% gain just in the first few weeks of 2026. 1 minute, the market smells blood on the floor. The next minute, it's sprinting higher like a rocket. Investors who piled into the 2025 rally now find themselves surfing a tsunami of panic selling, short covering, and volatile reversals. It's clear that fundamentals and technicals have collided head-on. In this opening scene of 2026, profit-taking from the big run, automatic index rebalancing flows, and a strengthening US dollar have all converged into a perfect storm. Recall that at the end of 2025, silver's big surge left it overweight in commodity indexes, forcing funds to dump about $5+ billion in futures this January to rebalance positions. The upshot? Silver is basically writing a new chapter of market drama every day. So is this meteoric action a bull market extinguished or a massive trap set for impatient shorts? Stay tuned, because we're just getting started with this epic saga. Let's break it down technically. What do the charts tell us about this wild ride? Silver's price action looks like a perfect textbook failure of bearish patterns. Many technicians are pointing to inverted head and shoulders and breakout patterns in the chart. For instance, analysts at FX Empire note that silver broke out of a long-standing descending wedge and even formed an Adam and Eve on double bottom, followed by an inverted head and shoulders on the daily chart. These bullish continuation patterns suggest that the path of least resistance might still be upward. In fact, FX Empire projects near-term upside targets in the mid-80s, around $85, $90 an ounce if the breakout holds. In plain English, on the charts, silver looks like it wants to keep climbing, despite the heart-stopping pullback. We've seen this theme before. The market lures in sellers with a fake breakdown, then snaps back. After December 29's waterfall drop, the daily candlestick left a classic hammer or pin bar, long lower wick pattern. The very next day's candle was a powerful bullish engulfing bar that erased those losses. It was a textbook V-shaped recovery. Imagine shorting at $74 expecting $70, only to watch it zoom back to $70 by noon. That's what happened. In trading chat rooms, one quip this week was, "Silver just took us all to the cleaners." It's an all too real squeeze the shorts scenario. The old saying goes, when the shoe's on the other foot, watch out. And right now, silver has put the shoe firmly on the bears. Traders who follow momentum indicators are also scratching their heads. Heading into last week, silver RSI and momentum had been stuck in overbought territory from the 2025 rally, classic warning signs of a pullback. And indeed, after peaking near $84, momentum did stall and flip negative. On the flip side, those oversold readings during the plunge have already snapped back as price recovered. In other words, the usual technical signals are whipsawing like crazy. You could say the market is spring-loaded. Any hint of hesitation from sellers and a fresh flood of buyers jumps in to catch the knife. Even veteran chart watchers are throwing their hands up in disbelief at these extremes. Let's not forget the moving averages and trend lines. Before this storm, silver had built a nice rising support trend from earlier lows, When that support was briefly broken on December 29th, it tripped a bunch of sell stops. But when silver quickly reclaimed that trend line on December 30th, it triggered a wave of buy signals. As of now, the 50-day and 200-day moving averages are still sloping sharply upward, with the 50-day well above the 200-day, a golden cross style setup. That tells momentum funds to stay bullish, but those moving averages will only protect if prices stay above them. The real question for technicians is whether silver can establish $74.75 as a new floor just around its 50-day MA, or if that level will break too. What about open interest in funds? Well, the January saga coincided with the annual index rebalancing. Because silver outperformed so much in 2025, major commodity indices forced funds to sell off roughly $5 billion of silver futures contracts in the first days of January. This mechanical dumping pushed prices down. Open interest initially fell, indicating those forced liquidations. Now, switching gears, how does silver's craziness compare to gold? Typically, gold and silver march together in a crisis, but silver's moves have been far more dramatic. The gold-silver ratio collapsed to the mid-50s recently, levels not seen since the early 1980s. That simply means silver is massively outpacing gold right now. Traders sometimes call silver the poor man's gold, but in this madness, it's more like rocket fuel to gold's flame. For example, during that US-Venezuela geopolitical spike, gold rallied roughly 0.8%, while silver jumped 0.7% on the same day. Silver essentially doubled gold's percentage move. It's common. Silver accelerates the trends. However, a ratio this low can also be a caution sign. Historically, when silver has run so far ahead of gold, some mean reversion tends to occur. If the ratio snaps back up toward, say, 60-70, it could drag silver lower relative to gold. Keep an eye on that metric. It's flashing an alert. And remember, gold is still important. If gold were to break decisively above $4,600, $4,700, it would almost certainly pull silver along to even higher levels. Conversely, if gold falters, silver would likely tumble even harder. What about the US dollar and other currencies? The Fed and FX markets are the puppet masters behind the scenes. In late 2025, the dollar index had been sinking to multi-year lows, which helped fuel the metals rally. But in early January, the dollar staged a surprise comeback. By Jan 7, DXY had bounced back up around 98.6 as traders shifted back to a slightly hawkish Fed stance. That was enough to put a lid on silver. A stronger dollar makes silver and gold more expensive for foreign buyers and typically pressures their prices. This week, as yields crept up to 4.2% on the U.S. 10-year, holding zero yielding silver became a bit costlier in opportunity terms. In plain terms, dollars up, yields up. Easy excuse for profit-taking in metals. Other major currencies also play a role. A rising dollar usually means the euro, yen, and others fall. A weak euro or yen can actually support metal prices in local terms. But in practice, we saw global traders hesitant anyway. With the euro slipping, European investors might have been poised to buy more silver, but the US dollar's strength dampened it. Meanwhile, the Japanese yen has been weak, trading near 150 per dollar, which ironically makes gold and silver cheaper in yen. And Japan saw some robust local buying. Emerging market flows matter too. For example, as the Indian rupee and Mexican peso weakened, local investors have been known to bid up silver as an inflation hedge. Altogether, the currency swings have just added gasoline to silver's fire. Any shift in FX can instantly flare volatility in metals. One final macro factor is the looming supply squeeze. China just declared silver a strategic material for 2026, effectively restricting its exports. Coupled with moonshot demand for solar panels and electronics, China is effectively hoarding more silver domestically. Meanwhile, physical stocks in London and New York have been dwindling. Some analysts warned this structural tightness in supply will cause swings to explode higher on any upset. In fact, Goldman Sachs bluntly states that these extreme price swings are likely to persist because the market is so thinly balanced between a few big hands. The takeaway: if China really starts stocking away silver, that could underpin prices even if Western traders panic. Investors' psychology is flipping by the hour. One minute it's panic and capitulation, the next minute it's FOMO, fear of missing out, and buying rush. When the parabolic rally met these crashes, some traders literally thought they were going crazy. One day you hear Wall Streeters yelling, "It's done for, sell everything." The next day Reddit forums are flooded with to-the-moon memes on silver. Retail buyers see every dip as a bargain, while funds quietly talk of taking profits. It is a tug of war between buy the dip and sell the rally on steroids. Technically speaking, the charts look like a war zone. We've seen failed breakdowns below key support, followed by explosive bull flags and surge patterns. Every time a stop-loss cascade starts, another avalanche of buy orders crashes it the other way. You could say silver is now fully de-risked. Any hint of staying above a level brings in a rush of bids. There is no safe ground. Momentum traders are getting whipsawed. Even stalwart analysts are admitting this is uncharted territory, with volatility measures off the charts. In this bear trap saga, silver has now checked every box. Monster drop, lightning quick snapback, and yet another shooting star spike. The market has given every signal possible of both exhaustion and continuation. Bulls point to the broken wedge patterns and still strong uptrend. Bears point to stalling momentum, stretched valuations, and tightening central bank policy. Everyone has an opinion, which only adds fuel to the debate. It's like watching a thriller movie where the villain might have gotten caught or just tricked us into a bigger trap. We've seen years' worth of moves crammed into a single week. The question now for traders is simple. Bull run paused or rally still on? If this is a true top, then last week's bounce is a brief respite before a real crash, and stops above will become sellers' targets. But if it's a trap, then those who braved the dip will get richly rewarded as prices head even higher. The market has literally seen both scenarios in 48 hours. For now, buckle up. We're just getting started unraveling the silver saga. All right, let's zoom out and look at the big picture. How do silver's crazy swings fit into the broader macro story with gold, the dollar, and other currencies? Spoiler, they're all dancing to the same tune. First, gold. Silver often exaggerates gold's moves, and that's exactly what happened. In this rally, both metals hit record highs. Gold briefly touched around $4,549, while silver went right along and topped 83.62. But silver's gains have been much larger in percentage terms. For example, during January's flash spike, gold climbed roughly plus 2.8%, whereas silver jumped about plus 7.9% on the same news. In effect, silver is the rocket fuel to gold's engine right now. One consequence, the gold-silver ratio has collapsed into the mid-50s, a low not seen in decades. In simple terms, silver has vastly outperformed gold. This is exciting for bulls. It means golding S breakouts become even more powerful. But it also means any weakness in gold tends to hit silver harder. usagold.com. However, a ratio this low can be a warning. Historically, when silver runs so far ahead, it sometimes has to take a breather. If gold falters or stalls, keep an eye on silver. It will likely correct even more aggressively. Next up, the US dollar and global currencies. All those jaw-dropping moves have been happening with the dollar as the backdrop. In late 2025, the dollar was weak, making metals pricey in dollars, but in early January it snapped back. As of John 7, the dollar index was up around 98.6, fueled by Fed officials leaning a touch more hawkish. That rebound in the dollar coincided almost perfectly with silver's retreat. A rising dollar literally makes silver more expensive for overseas buyers, creating selling pressure. Add in the fact that US bond yields ticked higher to about 4.2% on the 10-year, and all of a sudden holding nothing in yield assets like silver looks costlier. So the dollar or yield combo provided a handy excuse for the recent profit taking. Other currencies matter too. A rising dollar usually means weaker euro and yen. That makes precious metals cheaper in Europe and Japan, which could in theory boost demand, but in practice it also means more volatility. Global demand flows are another piece of the puzzle. Central banks and big economies are stocking up. Saudi Arabia and others quietly bought gold over the past year. Now China has signaled it will hoard even more silver by treating it as strategic. If that's true, much of the world's silver production may stay locked up in Asia, tightening supply even further. Meanwhile, London vaults and COMEX inventories remain historically low. Some analysts are warning of a real physical squeeze. This isn't just talk. When a market is this tight, any rumor of shortages can send prices lurching. Keep an eye on news out of China or India. They account for a huge chunk of silver demand. Don't forget, this rally isn't just about metals. Commodities across the board have been on a tear. Copper hit new records in December, and other base metals surged. Often traders say it's a broad metal mania driven by inflation or AI fears. Silver is riding that wave too. In fact, one Chinese report dubbed this entire move an AI bubble hedge. Investors are piling into anything scarce, including silver. In short, global industrial and inflation expectations are baked into silver's banner year. If oil or wheat suddenly crash, or deflation whispers return, that mood could reverse. So where does this leave silver? Right now, it's at a crossroads. If Fed or central bank signals turn dovish, say the Fed hints at rate cuts or freezes hikes because inflation cools, then the dollar down metals up story will reignite. A surprisingly soft jobs report or an FOMC statement without hawkish language could send the dollar back down, and silver would likely sprint to new highs. Similarly, any fresh geopolitical shock, a flare-up in the Middle East, a banking crisis shock, whatever, would flip the market back into fear mode and fund another surge. Conversely, if central banks stay hawkish and inflation stays stickier than expected, silver's fuse might be spent. Traders have been quick to say, this is the end game for the bull. If yields keep climbing and the dollar breaks even higher, the recent rebounds could prove to be false breakouts. In that scenario, silver would chop sideways or even roll over. Pattern watchers might start seeing ominous shapes, double tops, breakdowns of bullish wedges. It would turn into sell the news all over again. There's a silver lining for bulls. After that huge sell-off, many of the weaker short positions have been flushed out. COT, commitments of traders. Data show that commercial sellers have already covered a lot of ground. Some specialists estimate that index funds and momentum traders are now near record net long on silver. In plain speak, there's less pressurized selling left. Positions are lighter. If the market starts buying again, the next squeeze could be enormous. It's like a spring loaded in the other direction. The only direction with certainty today is volatility in both directions. So what should traders watch on the chart? Key areas are obvious, roughly $75 to $76 on the downside and $80, $83 on the upside. Holding above $75, $76, the floor of the recent range, and then breaking back above $80 would strongly favor the bull trap thesis. It would imply the buying is still alive. On the other hand, a clear break below $74 on heavy volume would throw a major red flag. That would open the door to a test of last summer S break level in the low 70s, or even a return to the 60s. Also, watch gold. If gold blazes past $4,600, silver will almost certainly tag along to new highs. On the FX side, keep an eye on DXY if it spikes back toward 100, and USD and JPY. Any sudden moves there often show up in silver S action, too. It's also useful to keep tabs on sentiment metrics. Are everyday investors panicking or still greedy? We already mentioned SLV flows above. They suggest a lot of retail buyers were still in the fight, even after the crash. On the flip side, survey gauges and social media chatter have been hitting extremes. When the mean man starts throwing out 100-plus targets, or the fearmongers talk about silver vaporizing to $50, consider that a contrarian warning. Crowds that become one-sided tend to be wrong. If everyone is screaming at $200 silver, it's often the setup for a surprise dip. But if the fear is unanimous and prices are very low, we could be in a pick up the pennies mode where even a small bid clips the shorts. Keep an ear on the chatter. Extremes in bullish or bearish consensus can flip the game. In sum, you really can't analyze silver in isolation this month. Its crash and rebound have been tied to gold's record run, the US dollar's seesaw, and a global scramble for hedges. When the dollar goes down or fear spikes up, silver rockets. When the dollar rebounds or fear eases, silver capitulates. That means all the macro knobs are still in play. Central bank policies, currency moves, inflation reports, geopolitics, they all matter. Traders are essentially watching a four-way tug of war every day. So here we are at the climax of our story, and the plot is thick. The silver market has given us a week of jaw-dropping moves, and now it's time to ask the million-dollar question. Where do we go from here? First, let's recap the crime scene. Silver's chart was red on Monday, then green on Tuesday, then red on Wednesday again, all within a stone's throw of its all-time highs. The drastic swing down last week, nearly a 10% plunge, was almost immediately snapped back. In fact, many technicians are already calling that a massive bear trap. What looked like a breakdown turned out to be a false alarm. Now the bears are bruised and the bulls are licking their chops. If you want technical clues, watch those key levels. Silver's current consolidation is roughly between $75 to $80. On one hand, holding support around $75 to $76 and then rallying back above $80 would cement the bear trap story. It would suggest that all those forced liquidations were just noise, and the bullish trend is intact. In that scenario, the squeeze could have more fuel. If silver clears $83 to $85 decisively, last week's high area, it could ignite another leg higher as myriad buy stops and breakout traders pile in. On the other hand, failure to hold would spell trouble. If silver cracks $74 on a weekly close, technical sellers would smell blood. The first major support below that is in the low 70s, last summer's breakout level. Break that, and the market could tumble toward the $60 range where this rally began. In that case, many bulls who bought the dip would be thrown into a nightmare. Leveraged positions unwind violently and a cascading sell-off could develop. Essentially, $74 for $75 is a line in the sand. Above it, hope lives. Below it, the rally might have run its course. So how do we tilt the odds? That depends entirely on new developments. If the Fed or other central banks hint at easing, for example, a dovish-sounding Fed meeting or a weaker-than-expected inflation print, then the narrative flips back to dollar down, metals up. A dovish surprise could send DXY back down into the 90s, unleashing silver's bull phase again. Any fresh geopolitical scare or market panic, like a banking sector hiccup, could likewise send everyone scrambling for safeties, igniting another metal spike. In plain English, good news for risk means bad news for the dollar, and that's usually good news for silver. Conversely, if central banks double down on hawkishness, say, signals that rates will stay higher for longer, the party could end abruptly. The brief bounce we saw in early John would then look like a run-of-the-mill rally in a bear market. Traders would point to broken chart patterns, e.g. failed wedge, bearish head and shoulders, and jump back to a sell the rally mindset. A forceful bounce in the dollar above 100 on the DXY, or a surge in yields, would likely coincide with silver sliding back toward the low 70s. In that world, this week's mini rally would be just a calm before a storm. Don't overlook fundamentals either. On the bullish side, China's moves could prove crucial. If their silver stockpiling really kicks into high gear, remember their new export controls, then global supply remains tight. Any hiccup in production or surprise demand could trigger another squeeze rally. Supply cuts from miners or streaming companies missing production could play into that as well. Imagine a Reuters or Bloomberg headline about a major silver mine outage. It could send silver back to the moon, given how stretched inventory already is. Sentiment is hysterical, which means any tiny sign can flip confidence. Think about it. Just a week ago, everyone was freaking out over a drop to $71. Now some traders are convinced this rally is bulletproof. Technical levels like $85 will take on mythical status. Break above and expect another stampede. Fail below and panic could ensue. It's a tug of war between FOMO and fear. One trader joked that this market is like watching a monster breakout and a colossal fake out at the same time. And that about sums it up. Here's some semi-good news for the bulls. After all the selling, most of the weak hands have been cleared out. Traders estimate that speculative funds have covered a ton of shorts over the last month. Some large momentum funds now have nearly record-long exposure, which means if the market turns up again, it could ignite a snowball of buying. In short, the spring has been pulled back. If it releases, it could snap the other way explosively. So, in some sense, the deck is stacked for a big move either way, with the potential magnitude still very large. What should traders be doing right now? At a minimum, track the key support and resistance. $74 or $76 on the downside, $80 or $83 on the upside. Watch gold's moves too. If gold breaks confidently above $4,600, silver will likely tag along up. Watch the Fed statements and dollar index. Any pivot or pop in DXY will be silver SQ. Also, watch position reports and flows, SLV and GLD ETF flows, futures positioning, even odds meter polls. When the sentiment pendulum swings to an extreme, it often reverses. It's also worth noting the crowd psychology at these extremes. We've seen social media get split between silver to $100 and silver crash 50%. When the most rabid bulls are all in, calling $100 or $200 targets, that S actually a contrarian signal, the smartest hedge funds will quietly watch that steam out before joining the party. Conversely, if everyone is crying bubble burst, then a flash surge is more likely. Right now, extreme optimism and extreme fear coexist, which actually means nobody really knows. So where do we land? In the short term, silver remains a total wild card. It could roar again if the stars align, Fed doves, safe haven scare, or it could slip back if higher rates stick. History suggests markets often overshoot on both sides in such panics. That means we should be ready for more fireworks, possibly another big leg, up or down. Over the medium term, ask yourself, is silver's price around $80 the beginning of a new inflation-driven era, or just a breathless peak in a crazy rally? I don't know yet. To wrap up this saga, remember, silver has proven to be a high-stakes, high-volatility game. With every massive upside move comes the risk of an equally massive downside swing. The chart has become a no-man's land where only adrenaline traders will thrive. If you're trading this, tread carefully. Use stops, limit your size, and acknowledge that market dynamics can flip overnight. In conclusion, the nail-biting drama isn't over. Silver's chart still has pages to write, and that final outcome could go either way. It's anyone's guess which forces will dominate next. Inflation fears or interest rate fears, dollar strength or dollar weakness, profit-taking or panic buying. All we know is that after this week, you're guaranteed not to see a dull day in silver again anytime soon. Stay tuned, stay sharp, and trade safe.